Hello, and welcome to Advisory Explained. I'm your host, Kosie Kritzinger. Join me in this series, this podcast where we discuss the complex world of advisory. We dive deep into very specific topics in the world of mergers and acquisitions, due diligence, tax, fiduciary services, and so much more, where we take complex topics and we break them down into smaller, bite-sized, palatable portions for you to understand and to understand where we can assist you. Welcome back to another episode of Advisory Explained, where we take complex topics in the world of finance, accounting, mergers and acquisitions, and law, and we break it down into simple understanding points for everyone to understand. Today, I am very special to welcome old friend Bruno Schwalbach to add to today's podcast, where we are going to discuss the ecosystem behind fund management and alternative investments, hedge funds, etc. Bruno, welcome on the podcast.
Thank you, Kosie. It's great to be with you, and after all these years, still lekker to call you my friend. So.
Yeah, absolutely. So just for the audience today, so Bruno and I actually met about just over 20 years ago. So he's played a significant role in my life as a friend and as a mentor, specifically at a young stage. So it's a full circle moment for me to sit here today with you, and I'm honored to be here.
No, likewise. I mean, we met in the karate dojo, and you made me better by always pushing. So I appreciate it, and it's lovely to engage in a different forum.
Absolutely. So for the audience, I'm going to do a quick intro on Bruno, and then Bruno, if I'm finished, I'd love for you to just expand a little bit on what you guys do in a bit more detail. So Bruno Schwalbach is the CEO and the CIO of Ironclad Asset Management. He specializes in alternative investment strategies designed to improve equity-dominant portfolios. He holds a PhD in finance from University of Wits and is a CFA chart holder. Bruno has published one of the most widely read recent articles on enhancing global equity portfolios through trend following and tail hedging overlays. And he also does jiu-jitsu over the weekends. Yeah, so big change from the karate, though.
Yeah, it's they call it ground karate.
Yeah.
So that's how I've replaced my Saturdays.
Awesome. So tell us a little bit about Ironclad. What do you guys do? What's your focus, etc.?
Yeah. So we, as Ironclad Asset Management, are systematic or quantitative asset managers. We are part of the wealth manager or advisor's toolkit in that we effectively exist to improve equity-dominant portfolios. So what we find in South Africa is we've got an exceptional conventional asset management industry that does an excellent job of the standard of implementing the standard toolkit of traditional assets. What's missing in our view, and the problem that we exist to solve, is effectively enhancing and taking this setup to the next level, because what ends up happening is most people become quite equity dominant in their portfolios because they're trying to achieve a certain high rate of return. And while that has done a good job historically, it does leave people quite concentrated in their exposure. And so we exist to enhance, improve, manage those risks. And yeah, I look forward to unpacking the specifics with you now.
If you think you are someone that could add value on this podcast, or you have an interesting topic you would like to discuss, please reach out to us via email. You are a fund manager and a hedge fund manager, which is two separate things. So my first question is, can you explain the two of them? And then you made reference to a world called the ecosystem. Can you help us better understand what you mean by the ecosystem and the toolkit, that you guys are actually a tool? And once again, to our audience, it's very important. Bruno is not the advisor, he's one of the tools that advisors use specifically. So if you can maybe unpack that a little bit, I'd appreciate it.
Yeah. So maybe starting with the second question first, it's much easier to understand where we fit in, and indeed where other hedge fund managers and fund managers fit in, by first understanding how the ecosystem is structured. So the typical scenario is an individual might approach an advisor or a wealth manager, family office. These are all fairly interchangeable terms, with the express goal of, listen, I want to have a reasonable sense of certainty that I'm going to be okay. By that, I mean have enough money to effectively live out my retirement days, and at best case scenario, have something to leave behind, a legacy, whether you leave it behind after you pass away or before, personal choice. But that is sort of the end objective that everybody, including myself and yourself, are after. So the typical first step is to approach a wealth manager. And as you said, I'm not a wealth manager myself. However, we work with quite a few high caliber, I would say world-class wealth managers and advisors. So I can speak to a little bit around their structure, the way they do things. So typically what they'll do is they'll engage that individual. That individual could be our age, and in the formation phase of their wealth plan, or they could be near retirement or even post-retirement. And a good wealth manager is able to handle the situation, whatever it happens to be. But typically speaking, the wealth manager is sort of the coach, the manager of the soccer team. And as the coach and the manager of the soccer team, the objective is to win the game. And to do that, they're going to put specialist players in specialist positions. They'll have a goalkeeper that does a specific function, a backline, a midfield, wings and strikers. And of course a bench. So the wealth manager is really the central cog in the entire ecosystem, because they make use of different suppliers, like myself as an asset manager and a hedge fund manager ultimately. And of course, what you guys do in the accounting side, and legal partners as well. So the ecosystem exists to help solve this problem of an end client having the warm and fuzzy feeling of, I'm going to be okay. That's the problem that they're looking to solve. The way they do that is by using people like us to help manage the money, people like yourselves to help with tax efficiency, and ultimately legal colleagues as well to help with structuring. So we're all partners in helping the wealth manager ultimately help the end client.
Absolutely. And just to circle back to the first question, specifically the difference between asset management or a fund and a hedge fund. If you can maybe sort of just touch on the difference between the two for the audience.
Yeah. All hedge fund managers are fund managers, but not all fund managers are hedge fund managers. So effectively within the ambit of regulation, a typical fund manager, what we call a collective investment scheme, used to be called a unit trust, is long only, which is to say they can buy long exposure in assets. By assets, I mean stocks or equities, bonds, cash, and property, which is kind of a hybrid between equities and bonds. And they're only allowed to buy long exposure, which is to say they're only allowed to buy it. They can't short sell it, and they're not allowed to leverage it, which is to say they can only buy up to 100% of exposure in any of these items for specific mandates. Hedge fund managers take that one step further, and they say we're allowed to we're allowed to ultimately derive the returns that we are after by adding two additional functions. And the first one is the ability to go short, which is to say to profit from assets falling in value. And we're allowed to leverage, which is to say we're allowed to go north of 100. So where a fund manager is limited in their not capability, but in their what they're allowed to do, to only go up to 100% long only, never short. A hedge fund manager is allowed to go short and also to leverage. It sounds scary. It isn't. When you understand what you're doing, you understand that these are nothing more than different tools in the toolkit in order to ultimately achieve your objective, which is to deliver on the return mandate that the advisor needs you to, so that the end user, who's the client, benefits.
Absolutely. And I'm gonna fall back to one of your comments in terms of the soccer team. So you've got your coach, which is your advisor, and then all your players are your different tools to achieve the goal of winning. Now, as I used to play hockey, I didn't play soccer. but I know the difference, or I used to experience and feel the difference between a good coach and a bad coach. And in your words, a world-class advisor that you guys also work with. So what is the difference, in your opinion, between a ordinary advisor and a world-class advisor? What distinguishes the two? Because at the end of the day, we need to understand, am I working with the right coach as well?
Yeah, so I can obviously comment a little bit about how the advisors that we work with operate, and I certainly consider them to be high caliber. So their process will typically start with conducting an in-depth needs analysis. I mean, sounds fancy, but ultimately it means sitting down at their office or sitting down in your living room and understanding who you are and what your objectives are. So that can be as simple as understanding where your starting point is in terms of what do you have in savings, what does your budget look like, what does your career journey look like, and elements like these that are fairly simple to put to Excel, but on the qualitative side, so not the quantitative side, this is where quite a bit of the skill comes in, is just actually understand you as a person. What are your objectives? What are your hopes? What are your dreams? What are your fears? And that's much harder to put to Excel. So when it comes to this idea of what is a world-class advisor, of course, there is the quantitative skill of pinning down exactly where you are in your journey, where you are in your business, where you are with your children, and so on, and round that out against your objectives, your risks, your constraints, these types of elements. So what they'll do is they'll conduct an in-depth needs analysis on this basis. And what they'll then do is map this out on effectively on an Excel spreadsheet to map out your future liabilities, which is to say, not only in this coming year, the year thereafter, but in year 6, when you expect to have another child that you wish to support in their journey through school and so on. You can sort of, it sounds a little weird to say, but that is a liability that you need to think through. All the way through into retirement, in terms of what is it that you're going to need to live off of, and ultimately what is it that you want to leave behind. So this can be neat and tidily expressed by way of a series of cash flows outgoing, and the objective is to then match assets to pay for those liabilities, and ultimately match assets and liabilities. This methodology really stems from the actuarial world, where ultimately actuaries are charged with understanding in depth a series of liabilities that a company might have, or pension fund, or some professional body, and understanding what assets can be used to mitigate, or rather to match those liability profiles to give you the highest probability that look, I'm going to be okay. That's ultimately what we're trying to achieve here. And so in my view, a caliber wealth manager will take the time to truly do a needs analysis and understand you as a human being, where you're going, understand what that means in rand terms, in dollar terms, and ultimately to then use their team to match the specific liability profile with an asset.
Absolutely. So, if my understanding is correct, we're saying a world-class advisor is someone that can truly pinpoint what is the roadmap that we have to achieve efficiently and effectively, in a timely manner for the client at the end of the day. And that's where the coach says, okay, what is our goal? We want to achieve X, Y, and Z over the season ahead, and be able to grow into next seasons coming ahead. Being able to do that, they need to go and sit for every single game with a game plan. And we need to build a game plan. And that's where they come in, and where they start using people like you in achieving that game plan for the clients at the end of the day. So, an elite wealth plan. How does an elite wealth plan then look?
Yeah. So ultimately, what we've seen from our advisor partners that has worked quite well is a clear bucketing system of liability assets that match each other, and assets being invested in such a way that you have a pretty high probability that they're going to be there for you to match the liability. So in practical terms, that means over the short term, if you know you've got a big outlay coming in the next year, for example, you want to have fairly high certainty that if something happens in markets, the asset that you've sort of pre-allocated to match that liability doesn't fall to the extent that you're then in trouble with meeting that liability, forcing you to venture out further into the risk curve and find money elsewhere to meet that liability. So what the advisors that we work with do is they match short-term liabilities with short-term assets, which is to say cash and cash-like instruments. So ultimately, this is distinct from whether it's in an RA or in a TFSA. The sort of the infrastructure is not what we're talking about here. It's the type of investment, and therefore the type of investment fund or fund manager that they put in as part of the team to perform that task. Then you look out medium term, and most advisors that we work with work on this time-orientated approach, which is to say there's short-term, which is anything between now and a year from now. Medium-term is, they have different horizons for different types of people, but you have typically short-term, medium-term, long-term. Some have ultra-long-term. Others talk about this idea of legacy, which is to say if you completely match your liabilities, you have this amount left behind. What do you do with that amount? But ultimately, it's a time-based approach, and what we like is that it gives us clear mandates on what it is that we need to achieve. Because the way you go about managing a short-term portfolio with cash and cash-like instruments, and that being your mandate, is very different from the types of portfolios that we manage at Ironclad, which is all the way out on the long side of that spectrum, with this express objectives of I need to deliver returns. And so the risk category is quite different. The approach that you take is quite different. And therefore the mandate is very different. But from what we've seen, a proper wealth management plan uses everybody in the spectrum in order to achieve ultimately the team's goal.
Absolutely, and we've got a big audience of wealth advisors listening to today's podcast, and also clients at the end of the day. And once again, I really like your analogy of the sports team. The fact is, you guys are probably, for a lot of people, a tool on the bench that's not being used at the moment as efficiently as possible. Can you maybe give an example for where a wealth advisor and why they should use you guys? What's the X factor that you guys bring, the value add that you bring? How do you differentiate yourself from other asset managers, other fund managers, and other hedge fund managers to be special, if I can call it like that?
Yeah, so extending the analogy, if we're on the bench, we're brought onto the field to score goals. And ultimately, we exist because through the implementation of the structure I've described, people end up ultimately being quite concentrated in equity as a standalone source of growth. And deservedly so. Equity has delivered historically. You can look at the US markets from 1900 to simply see this case borne out in reality. However, there have been decades over which equity has underperformed historically. We just haven't lived through those times in recent history, certainly. So it's not a risk in a lot of people's minds. And I want to be clear, it's not as if I'm an equity bear. I just mean, should equity disappoint, what do you have in your portfolio that can still drive returns? And that's ultimately the problem that we try to solve at Ironclad. We do it in three distinct ways. The first one is to enhance equity, which is to say what we try to achieve is to introduce sources of convexity. It sounds a bit funny, but ultimately what we're trying to achieve is to help your equity perform better at extremes, extreme good times and extreme bad times. And we've got specific tools that we use to do that. Secondly, equity alternatives, which is to say the problem that we're trying to solve there is that equity cannot be the only source of growth, long-term growth in your portfolio, because ultimately the true enemy that we're trying to defeat here is inflation. And most people use equity primarily to perform that function, but that ultimately means that equity carries a very heavy burden in people's portfolios, and we exist partly to help alleviate that burden with alternative drivers of growth that are not stemming directly from equity alone, that still deliver equity-like growth and then some. And then finally, we also have strategies that help diversify your portfolio. So most people end up with a portfolio that looks something like 60% in equities, 40% in bonds for that long horizon portfolio. And the difficulty is Sometimes equities and bonds diversify one another, meaning one is up, one is down when you need it to be, but sometimes they fall in tandem, which can be problematic. And so we have strategies that help counterbalance and introduce proper diversification, especially for when you have these rising inflation times and equities and bonds fall together. You need something that you can back to help diversify you in those times.
So, if my understanding is correct, that's where two things come in. That's where the alternatives come in, and that's where the hedge fund side, where you're allowed to short, also comes in. Can you maybe, and so there's actually a third point to this that I want to touch on, but the first thing that I want to ask is, can you maybe elaborate a little bit on the word alternatives? And the reason I'm asking is most people out there say, listen, I know two things, or three things. I know equity, I know bonds, and I know unit trusts. That's their sort of their world of that's the investment world that I can be in. On the flip side of that is I grew up with a show on Netflix or Showmax called Billions with hedge funds. And when I saw those guys, they bought investment art, etc. And that was as a school kid, my thought of alternative investments. I'm gonna do that and crypto, etc. Not saying you guys do crypto or not, but what what classifies as alternatives at the end of the day?
Yeah, great question. So alternative to what? So it's alternative to the three, maybe four primary asset classes being equities, bonds, cash, and property. Property is sort of a hybrid between equity and bonds. So that is what we mean by alternative. It's anything that is not those core asset classes that make up the vast majority of unit trusts or collective investment schemes, as they're now called. And alternatives have two broad categories, if you want to consider crypto a third, but that's not what we do. So the two broad categories of alternatives are private and so-called liquid alternatives. So private alternatives are typically private debt or private credit, as it's known, and private equity. The pros on that side are pretty clear. Good historical returns. The cons are also pretty clear. Very difficult to get your money out, especially when you need to. It is by definition. Part of the outperformance historically can just be explained by this illiquidity premium. On the liquid alternative side, which is where I work, you typically have hedge funds as the, shall I say, the wrapper structure around the strategies, but hedge fund is not an asset. You have a variety of different hedge funds. As you sort of mentioned, you have hedge funds which are as vanilla as equity long short, which is the biggest category in South Africa, which is to say that they're allowed to go north of 100% in terms of how they are long in equities, but then they can also bring that gross exposure, as we call it, back down to below 100% by shorting some other equity. So there's a variety of ways in which you do that, which can ultimately mean that you either on a net basis leveraged or even short. But that's sort of the most vanilla type of hedge fund is equity long short. At the other extreme, you have elements like art and these types of very difficult to value assets. Racehorses in Ireland is another example.
Yeah.
And we certainly fit in between. And what we're trying to really achieve is as good as those types of hedge funds are that I've just mentioned, the problem that they ultimately suffer from is that the source of the returns ultimately stem from equity. So whether you're able to go long or whether you're able to go short or leverage, ultimately your return stream is derived from equity, as is the case in unit trusts. And you might argue that it's a better source of return, but ultimately it is equity dominant. And that's really where we try to help as Ironclad is we come to the table and we arrive at the coach's bench with the understanding that, listen, your team is equity dominant. How do we reduce your reliance while still paying homage and sort of a hat tilt towards equity being the dominant asset within your portfolio? So I can expand on two specific ways we do it. There's others, but the first is a strategy that's very well known internationally. It's a massive category about the size of our entire retirement industry, called trend following. Managed futures, CTA, is another expression. And in that asset class, it is a hedge fund structure by nature, but ultimately what it does is it can go long or short for the four primary global asset classes: global equities, global bonds, currencies, and commodities, which is a aspect that people don't tend to hold within their portfolios, at least directly. They have proxies gold miners, silver miners, etc. But we like pure commodities in and of themselves, which are absolutely an alternative that is worthy of consideration. And for the primary reason being that when inflation rises, equities and bonds tend to suffer often in tandem. Commodities are often the source of that inflation to begin with, and therefore do well, and so present a wonderful counterbalance in those circumstances.
Well, sorry, Bruno, for just on that note. So we are currently in an environment where gold is doing very well. And that is a big question, is how does that actually impact, although that's not part of today's main point of conversation. But the fact is, gold is doing incredibly well at the moment. It has a fantastic rally over the last year, which has grown significantly. And my heart goes out to everyone that's not in gold or that wasn't in gold. Yeah.
Yeah, well said. Look, we as South Africans do benefit just by virtue of how resource heavy the JSE is. So we do benefit by proxy from the gold price rising. Within our trend following strategy, and trend followers at large globally have more directly benefited from that rise. So everybody talks about gold's increase. I wonder how many know how well silver has done over the same period. So from June of 2025 until 29th of January of this year, silver more than tripled in value. At the same time, gold was up very strongly, more than 50%. And then on the final day of January, you had a one-day precious metal crash. So silver fell 30%, slightly more than 30% in a day, gold 12. And so who were the beneficiaries of this kind of rise? And we really, this is the type of circumstance under which trend following, which is a strategy we run and we know well, and very few South Africans ultimately have in your portfolio, excels at, which is to say trend following is outlier hunting in its nature. It effectively goes long markets that are rising, short markets that are falling, and profits from a continuation in those trends.
And you guys do that through your quant analysis side, correct?
Yeah, exactly. So we identify all the way back in June of 2025 that this fringe asset silver is doing some interesting things. It's up strongly. We have no fundamental view on silver. We're quantitative managers or systematic managers, and the rules say that we should be long silver because silver is rising in value. And so as part of the trend following sleeve, you're long assets that are going up with the expectation that they will continue to go up. And you often get it wrong, meaning that you buy just as an asset starts to go up and it falls in value, and you have these false starts. So that's the cost of the strategy. But without that pain, there is no premium. And ultimately, what transpired was from June 2025, we were long both gold and silver to a significant extent and participated fully in that rally. What was then interesting is to say, okay, well, did you give it all away on the 30th of January of this year when you had that one-day crash in precious metals? And the nice thing about the moment that you step away from the traditional long-only realm and you enter the hedge fund realm, you stop allocating units of rands or units of dollars, and you start allocating units of risk. And what you're trying to achieve ultimately is a fairly balanced and consistent risk profile. So when assets are not jiggling too much, which is to say that they're quite low in volatility, you're happy to give them a higher allocation. But the moment they start to go up and down with some fervor, you start to reduce that allocation because you don't want that asset to dominate your portfolio returns. So 10 Rand in an asset that's moving 50, up and down tremendously in a day is a very different risk than 1 Rand in that same asset. So you express your risk management by way of sizing. So as gold and silver was rallying up and up and up, we trend following in general held positions in gold and silver that were quite meaningful. Then the moment that a rally became, I don't want to use the word bubble, but shall we say a little bit unruly and
The fundamentals didn't match it anymore.
It just started to move wildly. You see that by way of volatility spiking tremendously, and you start to take some chips off the table and to reduce your position. And ultimately that results in capturing 20% of the upside, and then on the 20% returns in that period. And then on that final day, you're only down 2 or 3% in a day that silver fell 30%. And that's just by way of systematically and quantitatively managing your risk along the way and taking some profits and taking some risk off the table in anticipation of these big events. So that's a
Absolutely. And I think that's you're making a very good point then. Once again, from a individual sitting on this side of the table, understanding is and hoping my coach plays with the right players, such as a hedge fund manager like you guys in the team, is I also need to understand the risk profile. You mentioned earlier that most people think and experience that hedge funds being able to go short is very much more risky than going long on equities or any other assets. Can you maybe explain how you guys consider and do risk parameters, if I can call it, for asset classes?
Yeah, absolutely. So we've got risk management embedded in every single sub strategy that we manage, and then ultimately we've got a standalone form of risk management that is called tail risk hedging. So we effectively use options to accomplish that. And what we're trying to achieve in that sleeve is ultimately to help defend against the losses that are consequential to the maths of compounding. A little important. When you're down 10% in your portfolio, you ultimately need 11% to get back to break even, just how the maths of it works. If you're down 50, you need 100% to get back to break even. So large losses are very consequential to how you compound over time. It is absolutely true that compounding is the eighth wonder of the world. It's
Yeah.
absolutely the case. However, taking one step deeper to understand how compounding actually works, you quickly understand that large losses, the big red months, the big red quarters, the big red years, are by far and away more consequential than missing out on the big green months, big green quarters, big green years. And so the best tool with which to help defend against those calamitous events, we're talking 2008 global financial crisis, 2020 COVID crash, losses in excess of 25% over a very short period, are in our view, using options in a specific way that we do. It is extremely useful and beneficial to effectively warehouse your risk and to basically give it to somebody else's account. And therefore, these options do cost money, as you would expect. It's basically insurance, and no sane market gives away insurance for free.
Yeah.
And therefore, the role of tail risk managers like ourselves sort of don't judge us how we do in the crash, judge us how we do between crashes. How do you keep that sleeve affordable? How do you pay for that insurance over time? These are the interesting questions that clients ask us and that we're happy to discuss. So at sort of the single sleeve level, that is how we do risk management to the extreme events. We don't worry about the benign 5%, 10% drawdowns, and it's important on the long side of the ultimate end client's portfolio. So we're not talking about money that the client needs over the next year or so. Advisors will rightfully slot this type of payoff profile in to money that is required over the very long term. So that's important. So it's within this mandate, we understand that our job is to deliver inflation plus outcomes. And we understand that to do that, you need to take risk. And to take those risks, you effectively expose yourself to these very large, Nassim Taleb calls them black swan events, where you have a very low probability of a very high impact event that can erode compounding benefits over the time. And so we brought in to help manage that situation while keeping it affordable between big events.
Absolutely. And just for all the viewers on today's podcast, Bruno spoke about options. So there's basically two main types of options. You get put options. I put the asset to you, and you've got call options. I call the asset back. Just for me personally, how I remember the difference between the two. So I'm speaking as if I'm working with the asset. A put option is I have the right to sell this to you at a agreed on price, and a call option is I have the right to buy an asset at a specific price. And as you specifically said, it is insurance, and insurance comes with a cost. So there is a premium you pay for the ability to be able to put or call to an asset in a strategy. Just for everyone's example, as a quick example to explain a put and a call option is, if you think about your house, if I want to sell my house to Bruno, and Bruno has a call option on my house. Today's the market value might be R1 million, so we agree at R1 million, and he has the right to call the asset. If it grows to R5 million, he can still buy it at R1 million. Put option is the flip side of it, is I have the right to sell my property, my house, to Bruno for R1 million, but if the price drops to 200,000 rand, I still have the right to sell it to him at R1 million. So that is how put and call options work, and that's essentially how you manage a lot of risk.
Yeah. So ultimately, when people think of investing, they think about the price part of investing. Prices go up, and therefore I want to participate in that. And if you introduce trend following or other hedge fund strategies, prices can also go down, and you'd also want to participate in that. But what tail hedging does by way of the options is helps you participate in the volatility that those prices generate. And so you end up in a scenario where you can effectively materially profit from chaos. Prices falling at a very fast rate or rising at a very fast rate and benefiting from the volatility of those price changes. So if you sort of ask, well, why hedge funds at all, and you ignore the return side of the argument and how it can complement the existing core portfolio of equities and bonds and cash and property that you already have, when professionally managed, it is that you just add so many different tools to your toolkit when implemented correctly.
Absolutely. Bruno, as we kick off or actually close off today's masterclass, if I have a wealth plan, if I'm a wealth manager, or even if I am as a client behind the wealth manager sits and says, listen, there is a plan currently for me that my coach is running. What are 3 questions that I can ask of myself, of my coach, on to pressure test my current wealth plan to determine, is this still the right plan for how life is currently and what our plans are going forward?
Yeah. So based on the assumption that you pressure test that portfolio and it stands up to scrutiny in terms of under most scenarios I'm going to be okay. The way I think that wealth managers might consider improving that outcome is by increasing that probability further still by doing one thing and one thing only, and that is helping equity do the heavy lifting that it's doing within that plan. Most people will rely almost exclusively on equity to deliver those very long-dated, high returns that they need for their plan to pay off. While this has worked in the past, and I'm not now suggesting it's not going to work in the future, there's very good and compelling evidence that to believe it will, how to safeguard and how to improve that plan, it would be to effectively have something other than equity to help you achieve those outcomes. We think of this problem set in 3 ways. The first is, how can my equity perform better at extremes? And we obviously think that trend following and tail hedging can do a lot of work there. The second is, what alternatives do I have to equity that can still give me that inflation plus 4, 5, 6, 7% over time without exclusively relying on equity, because I have so much of it. And for that, we've got absolute return strategies that are unlike those that many have come across before, because they target high growth objectives and not low growth objectives. So it is trying to give you equity-like returns not sourced from equity. And then the third and final is, today we have excellent strategies that are not core assets in the form of equities and bonds that can help diversify your portfolio. Commodities is an obvious one. And there's good ways to invest in commodities and bad ways to invest in commodities, and we can expand on that in maybe a future episode. But drivers of returns that do well in different economic environments than just equities and bonds. So these are the 3 big categories. How can you enhance the equity you've already got? Are there any alternatives to the equity that you've already gotten? Are there other diversifiers within the alternatives realm that you can consider to improve an equity dominant portfolio?
Absolutely, and that is so crucial. And the whole time in my mind, it's just running back to say, listen, that's not my game, and it's also not my responsibility. There are specialists like you guys out there focusing and giving your all to make sure your strategies are effective, they work, and they beat the market consistently, and they keep on growing. So Bruno, once again, thank you so much for joining today. I must say, when you spoke now about commodities, it made me thought back about COVID. one of my friends thought it's fantastic and we're going to start investing in oil options. And I put all my savings in oil options because it can't go negative. Needless to say, it went negative. But in any case, so we need people like you guys to help with these strategies because it's not our expertise.
No, I appreciate that. And as a closing thought, options are one of, if not the primary asset or instrument that you should always leave in the hands of professionals, because with options you can get your call right and still find a way to lose money. So it is the final boss, and it's the final boss for a reason.
Absolutely. Listen, everyone, thank you so much for joining in today on Advisory Explained. Bruno, once again, thank you for making time to join us. And I hope that everyone got something out of today's discussion, where we discussed a little bit the difference between normal funds and hedge funds, and how to use specialized tools in your wealth plan. So for all the individuals out there, all the wealth planners out there, if you are looking for an additional tool in your toolkit to help your clients, please reach out to myself, reach out to Bruno. We'll be glad to assist you. Thank you very much. Did you enjoy this episode? Please like, subscribe, and share with your network.